All right, good evening, everyone. I believe the serious ones are here. This the class was opened by 6:30, and we've already wasted 6 minutes waiting for other traders to join us. 6 minutes is enough time for anybody who is really ready and prepared to join today's class to be able to join. So, guys, without not wasting much of the time, today's topic we will be talking about premium versus discount pricing. Now, you guys understand very well that we've talked about supply and demand zones, we've talked about order blocks, we've talked about imbalance. Today we'll be talking about how to pick the valid supply or demand zone or a valid order block. How to differentiate the one that will be more valid, the one that price will react to, over the one that price will take out. Because one thing you need to understand is that it is not all of the zones you mark out, it is not all of the supply or demand zones that you mark out that is going to give you a good reaction until price hits your TP. There are some other supply and demand zones that you're going to mark out. Once you mark it out, the market will go, once the market gets there, it will break through your supply or demand and take your stop loss. So for this reason, due to my years of trading, due to my years of experience, due to how many times these things have happened to me in the market, right when I was starting as a beginner till when I became an advanced, until when I mastered the whole concept, this is one concept within the smart money concept that has really stand out, which is the premium and discounting pricings, right? So let me share my screen right now so that you guys can be able to see the screen. All right, guys. So this is can you guys see my screen? Can you guys also see what I have on the screen? The premium and discount pricing. Let me just put this whole one up on the screen. This should be more better. Can you guys see what I have on my screen? Alright, guys, so can you guys see what I have on my screen? So what I have on my screen here is the premium and discount pricing PDF, which I will be using to teach you guys, and also use TradingView to show you guys example as well. Now, We all know that Forex trading is the simultaneous buying and selling of currencies. And now we are traders. Our duty is to analyze the market and look out for high probability trade setups. High probability trade setups are those kind of setups that can give you 80% assurance, right, over some setups that can give you 40% assurance, right? Which means with all the compliance that you have, with all the confirmations that you have, a high probability setups has the possibility to play out over a low probability setup. So using the premium and discount pricing can help us a lot to identify the areas we should be buying and the areas we should be selling. It also helps you identify the areas you need to avoid buying or the areas you need to avoid selling. It also tells you the zone that might likely held, right? The zone that might likely give a reaction over the zone that will be taken out as liquidity. You understand? Because when we can have 2 to 3 zones and we are confused of which one to buy or to sell from, because we already have 3 zones that has imbalances. What helps us pick a zone in this kind of a situation where we have 2 to 3 zones is using the fib to know where the premium is and where the discount is, and to know which zones are positions within a premium or within a discount. You understand? So now let's talk about like the textbook stuff. The above example is a premium versus discount pricing model. You can see what I have on my screen over here. What you can see is the upper one is the premium, while the down one over here is the discount. Can you guys see what I have on my chart? If you can see, let me know. So we'll continue.
Yes.
Is it very clear?
Yes.
Very good. Now, the above example is a premium versus discount pricing model. We want to sell from the premium and buy from the discount. This is a simple fib tool with the 0, 50 and 100% setting. I'm going to teach you guys how to set your Fibonacci this way. So if I forget, remind me. I'm going to help you set your Fibonacci to be like this after teaching you how to use it. So this simple tool will help us ensure we get the best deals on our investment. Now this Fibonacci, that guy can mute himself, the guy that is making noise. Can that person mute himself? If you know very well that the noise is coming from your end, please mute yourself so other people can concentrate. Thank you. If you refuse to mute yourself, I'll kick you out so we can have peace and learn well. Thank you. Right now, so this is a simple fib tool with the 0, 50 and 100% setting. This simple tool will help us ensure we get the best deals on our investments. So now let's use some trades for example. So here we are going to dive onto our trading view. We are going to move on to our trading view. So right now, if you see what we have on our trading view, right, you'll see that we are going to be using this Bitcoin trade for example, right? Now let's say if we want to buy this trade, what we are going to do is we are going to pick our Fibonacci tool for a bullish structure, which means buy. We are going to fib from this low point, which means we are going to fib from this low, the very low that the impulse started, and all the way to the very high where the pullback started, which means where the impulse ended and then the pullback kicked in. So in this case, this is where the impulse started and then this is where the pullback was considered. Now if we want to take this trade for sales, we are going to be entering from this level here and then taking the trade into this guy before we look for an opportunity to buy continue. Do you guys understand? All right. So in this case, first thing first, let's first of all see how to pick our Fibonacci tool from the fib. We fib from the lows. That's for the bullish market structure. Okay, let me not start right now. Let me first of all show you a textbook example of what I'm talking about. Let me show you a textbook example of what I'm talking about. So for example, let's say the trade is going this way, we get a pullback, right? Then we get a continuation, then we get another pullback, right, into this demand, followed by another impulse. So in this case, we are going to pick out all demand zones that price is reacting from, right? Now price has already mitigated this demand zone and price has already broken structure to the upside twice. Are you guys following up?
Yes.
Price has given us 2 breaks of structure and the market is bullish. Now in this case, we know that price is going to do a pullback, right, before the continuation. So at this point, we don't know where we should be entering the market from. Do you guys understand? We don't know where we should be entering the market. So the fib tool is what is going to tell us where we are going to be entering the market. You understand, guys? This tool is going to tell us where we should be entering the market. So in this case, we are then going to use our fib tool because now the problem is going to be like this. Let's say for example, we have a demand zone over here, right? And then we have another demand zone here, right? So in this case, we have 2 demand zones. You know, when the market gives you 2 demand zones like this, most time you'll be confused, most especially if this one has open imbalance that needs to be filled, and then this one also have open imbalance that needs to be filled. So now in this case, you're going to say, okay, this is the demand zone, right, that led to the break of this structure point. So we can say we have this, we are going to get this and then a continuation to the upside, meaning that price might not likely come here. Now this is what I want you guys to understand. I want you guys to understand the profits in buying low and then selling high. So let's say, for example, this is BTC, right? This is Bitcoin. So for this Bitcoin, let's say the market around here is $5,000. Let's say the market is around $5,000 at that level, right? So let's just say is around 5K. If that level is 5K, then this level is around 13K, right? This level is around 13K, right? Now you as a trader, if you want to buy, should you be buying something for 13K when you can simply wait and buy that same thing for 5K? So which one is cheaper for you as a trader? And secondly, you also need to remember that for price to continue a buy or a sell, it has to do a deeper pullback to attract buyers or sellers. When I mean it has to do a deeper pullback, I mean price has to pull back all the way to the origin, to where this impulse to the upside started from. You are getting me, guys? So let's say, for example, this be the low before this impulsive move to the upside. Now, this whole impulsive move to the upside was caused by the buyers at this structure point. And you remember that during the market structure, I said once price takes out a previous high, in this case this high, then profit taking is going to take place. All the guys that bought here, who used the previous high as their take profit level, they will start to exit their positions. They will start to take profit and leave the market. And once they start to take profit and leave the market, is going to cause price to start to do what? To pull back. The market will become weaker. And it will trade into a demand zone where buyers can find attractive price to continue their buying momentum. Now, what I want you guys to understand is this. When you use your Fibonacci tool, the way I use it, the way you might be using your Fibonacci tool might be different. The way you learn about Fibonacci tool might be different. But when it comes to smart money concept, this is the exact Fibonacci tool you should use. And this is the exact way you should use this Fibonacci tool, right? For buys, for us to know where price is cheaper, we want to fib from this low and take it all to this high. We take it all to that high, right? So that we can know where the premium and the discount pricing is laying. Now, if you look at it, the high up here is the premium. The low down here is the discount. So let's go back to our PDF. In this PDF, up here, which is the premium, is the seller's territory. Down here, which is the discount, is the buyer's territory. Buyers love to buy things when they are cheap. and sell them when they are what? Expensive. So sellers start selling their products when they have good prices. Buyers start to buy products when the prices are cheaper. You understand, guys? So in this case, what we have here is that this demand zone here is a fake demand zone, and it is therefore considered to be an inducement. Liquidity. Inducement. Liquidity. That is going to be a liquidity right there. It's not a demand zone. They only created this demand zone to attract buyers, to mitigate this demand, pull up. When they start pulling up from this demand, buyers will start to enter. They will even create more liquidities around this area, and the next thing, they will bust the market into its origin, taking out all the early buyers. Everybody who entered around this territory, they will take out all their positions, sell deeper, and then the buy can then automatically kick in. So always have a mindset of buying cheaper and selling expensive. Buy low and sell high. Now, what this simply means is this. What this simply means is this. Let me take out this thing so it looks more cleaner. Hello, are you guys following up? You're going to add these things to your analysis. The way I teach you guys is the way I analyze. You understand? Right? So I always follow the full step of my analysis. I look at market trend first. We've done market trend. I then look at market structure. Secondly, we've done market structure. I then look out for supply and demand zones. We've done supply and demand zones. And then I look out for other blocks with imbalances. We've also done other blocks with imbalances. That's why I'm doing this one now. Once you've seen your other block with imbalance, the next thing you have to check is to know if those imbalance you're looking to buy or sell from is at the right place. Do you understand? So after picking your other blocks and your imbalance, use your Fibonacci. Don't forget, try to check if the market is below the 50% if you want to buy. Any demand zone within that 50%, any other block below that 50% that has imbalance, you can buy from there. But if it is above the 50%, avoid it. If it is above the 50%, avoid it. That is going to be used as liquidity. The middle here is the equilibrium. That's the fair price. People don't like to buy at the equilibrium. That's why market consolidates around the equilibrium too much. People can only sell above. People can only buy below. So as I'm teaching you with this uptrend, it also refers to the downtrend. So now for the downtrend, what you're going to do is that you're going to fib from the most recent high that led to a break of structure all the way to the low point, that maybe you see that reversal has started kicking in. From there, you understand, you've seen that reversal has started kicking in from there. Now if you look at the BTC trade, BTC trade that I did analyze the other day, the reason why I simply was waiting for price to come to this area is because if I wanted to buy, I used my fib, right? I used my fib to fib from the most recent low all the way to the most recent high, which is this high up here. The reason why I did not buy here is because it was above the 50%. This was the only demand zone that was below the 50% that has a large imbalance. So I was simply waiting for price to come into this demand before I can buy the price higher. But as much as I was waiting for buy, I know that automatically for price to buy from here, price has to sell from somewhere around here. Now, if you look at the class we had the other day, when we had that class, market was around the 92k price. This was where price was. For those of you that saw the trade, when I sent the trade, the market was around 92k, was around here. This was where price was when I did that analysis. Why did I not sell from here? I knew that price will need to push into a more premium level, like an area where it will attract sellers to sell. So therefore, I use my Fibonacci to feed from this high into this low, right? You can see I feed from this high to this low, and this area was within below the 50%. If I wanted to buy at this yellow line, I could have made a lot of money. You understand? Because it was around the buy territory, but I'm waiting for price to cross into the seller's territory before I can look to sell. That was why I told you guys to monitor the trade. That's what we want to do. You want to make sure that you're conscious of where you're buying or where you're selling. It has to, if you're selling, it has to be around the premium, and if you're buying, it has to be around the discount. Don't just buy because you see an order block. Don't just sell because you see another block. Buy because where you're buying is cheaper. Sell because where you're selling is expensive. You're getting it? Now, if you see what I have here, right? I said number one example. In a bullish trend, the fib is pulled from the start of the impulse to the end of the impulse. The impulse must break structure and confirm trend continuation. We then want to wait for discount pricing, the lower 50%, before we buy again to make sure we have the best pricing possible and we are not paying too high of a price to acquire our position. This is on the 4-hour time frame. So now look at this example here. You see this example here. When price was inside above the 50%, what do we see? We saw a sell, right? When price traded into below the 50%, we start price buying. When price traded into the 50%, above the 50% again, what then do we say? Sell in below the 50%. When the price came below the 50%, what then do we say? We saw a buy. You understand? Everybody that bought here, they are going to lose when the price makes this deeper pullback. So the best thing is use your fib and know that this is the new demand zone that price is going to react from. See how price then came down, reacted from it, and then impulse to the upside. We have another example here as well. Now, if you look at this example, what will you see? You will see that we have this zone up here, and we also have this zone around this level. So you see that when it was above the 50%, price sold. When it sold into the below the 50, when it got below the 50, price bought. Once it bought into the above the 50, it sold again below the 50. Once it came into this 50, that's when we started seeing the market buying. Now, did price respect this supply zone? Why did price not respect this supply zone? Because there was another supply above here that was confirmed more cheaper than this, for a more expensive than this level. So anybody that is selling here will make good profit than anybody that is selling here. Now, market did not respect this one because it was around the 50%. But market respected this one because it was around the premium pricing. You're getting it, guys? So now, this is a new concept, but it is a very important one. You must always want to identify your range in price. When I speak on range, it can mean two things. The previous swing high to the previous swing low can create a trading range, or simply a consolidation areas, high and low. When we think about premium and discount, it's always the lowest risk to enter a position at the edges of the range high or the range low. Also, entering a position above or below, entering a position, I want to make it bolder so you guys can see what I'm reading. You get? So entering a position above or below the range is ideal depending on liquidity. That means if you take your current high and low and draw a line right through the middle as seen above. So now what we have done is create a rule. I am only buying below this line and I am only selling above this line. Remember, at the same time, we are always keeping in the back of our mind what the overall direction of price is in for that particular time frame up to certain levels. This should always be on your awareness. Being a professional trader, you are going to have to develop the skill set to be aware of multiple aspects of the chart. Don't worry, it gets easier over time. The more you do it, the more it becomes part of you, the more it becomes easy. But try to make sure you apply all of these things so that all of it will be part of you. Now, whenever I trade, I apply all of these things, and all of these things is not part of me. That's why I can teach you. That's why I can use it. So don't worry about starting now, right? It will be part of you. Just be consistently using it. Premium and discount can be used on any range and on any time frame if you are aware of the other time frames. So the better you get at trading, the easier it is for you to dive deeper into the time frames to reduce your stop losses next to nothing for now. Stick to the higher time frames until you can handle the others, right? Stick to those time frame until you can handle the others. So we have 1 minute to take question, guys. If you have question, you can ask. We have 1 minute to question. Now I'm going to, this video is being recorded, guys. It's being recorded, and I will share the setup. I will share everything into the Discord for you guys to watch. I don't know if you guys are studying those videos. We've had from day 1 all the way to day 8. Today is day 9 and we are still counting and we are still going. You right? We'll do all of these things, and after all this topic we are going into the application. That's why I want you guys to be studying this video so that you know how we apply these things. You understand, guys? Thank you. Thank you. Thank you. All right. Any question? Or next class?
Question is the premium at that premium level. That is where I have my confusion.
Now, the premium, you only use the premium when the market is selling. When you want to sell, that's when you use the premium. Then only use the discount when you want to buy, which means when the market is in an uptrend. Flip from the low to the high. Right?
Equilibrium.
You say?
Equilibrium.
No, don't buy at equilibrium, don't sell at equilibrium. The 50% is the equilibrium. So let me share this, my screen right now, so you guys can just take a snapshot. Are you guys still there? The class has ended. All right.